Hi guys, welcome to my channel. Imagine a company suddenly receive $100 million in excess cash. The CFO knows the money will be needed in 6 months to build a new factory. Where should that money go? Putting it into a risky stock investment would be a terrible decision, but imagine a pension fund managing billions of dollars for retires decades into the future. Each investment needs are completely different. This is why financial markets are divided into two major categories: money markets and capital market. The difference is not just about the type of investment, it is about time horizon, risk, liquidity, the purpose of the investor. Today, we will understand how professionals decide where short-term cash belong and where long-term capital should be invested. So far, we have classified financial markets in several ways. We look at primary versus secondary markets, exchange versus OTC markets. Now we introduce another important classification is maturity. Maturity simply means how long until the security is buy or is repaid. Based on maturity, financial markets are divided into the money market and the capital market. The difference is surprisingly simple. The money market focuses on short-term debt instruments, usually security with original maturity of less than 1 year. The capital market focuses on long-term financings. This includes long-term debt, stock, and other equity security. The key idea is money markets manage short-term funding needs and capital markets support long-term investment and ownership. So let's begin with the money market. The money market is used for short-term borrowing and lending. The securities trade here typically mature in less than 1 year. Why does such a market exist? Because business, banks, and government constantly experience temporary difference between cash inflow and cash outflow. A company may have extra cash today but need it next quarter. A bank may receive deposit today but need to manage daily liquidity requirements. Instead of letting that cash sit idle, they invest it in short-term securities. The goal is not usually aggressive growth. The goal is safety, liquidity, and earning some return while waiting. Think about the money market as a financial parking lot. You do not park your car there because you want to travel somewhere. You park there because you need a safe place to keep it temporarily. The same idea applies to cash. Investors use the money market to store funds safely until they need them. One important characteristic of money markets is liquidity. Liquidity means how easily an asset can be converted into cash without a significant loss in value. Money market securities are usually highly liquid because their maturity is very short. Consider two investments. Investment A matures in 3 months. Investment B matures in 20 years. Which one has more uncertainty? The answer is 20-year investment. Over 20 years, many things can change: interest rate, inflation, economic conditions, credit conditions. But over 3 months, there is much less uncertainty. Because short-term security has less price fluctuations, investors generally view them as safer. This is why banks and corporations frequently use money market for temporary funds. They are not looking for maximum return. They are optimizing liquidity and capital preservation. Let's move to capital market. The capital markets is when longer-term financing happens. Unlike money market, capital market include both debt instrument and equity instrument. Examples include corporate bonds, government bond, common stock. Why do these markets exist? Because business need longer-term capital. A company building a factory does not need money for 3 months. It may need financing for 10, 20, or 30 years. A technology company developing a new product may require years of investment before generating profits. Capital market provide the funding need for these long-term projects. This is where financial market directly support economic growth. Company raise capital, investor provide funding, business expand, new products are created, jobs are generated. Now let's compare this market from an investor's perspective. The money market is about stability. The capital market is about growth. A corporation holding its cash for a few months does not want a large price swings. It values liquidity. A pension fund investing for 30 years had a different objective. It can tolerate short-term volatility because it needs long-term growth to meet future obligations. This explains why different institutions participate in different markets. Banks and corporations often dominate money market because they manage short-term cash needs. Insurance companies and pension funds are major participants in capital market because they have predictable long-term liabilities. The investment decisions always start with one question: when will I need this money? Time horizon determines the appropriate market. Let's imagine two investors. Investor A company CFO. The company has $50 million that will be used in 9 months. The priority is protecting the money. A money market investment makes sense. Investor B, a retirement fund. The fund has obligations that extend 30 years into the future. The priority is growing assets over decades. The capital markets is more appropriate. Both investors are rational. They simply had a different objective. A common mistake beginners make is asking which market is better. That is the wrong question. The correct question is the market matches the investor time horizon and risk requirements. Thanks for watching.